We're often asked by clients, how should they allocate their 401k deferrals? Many 401k plans allow for the employee deferral to go into a Roth account. For 2024, the 401k deferral maximum is $23,000, with an additional $7,500 available for taxpayers 50 and older. Here are 4 things to consider when thinking about your 401k deferrals. What's your marginal tax rate today, and how much tax will you save by making pre-tax deferrals? Here's an example of some analysis we did for a client. Their name has been changed for this illustration. We use tax planning software to compare Bob's marginal tax rate with a $30,500 deferral to a traditional account and compare that to making that same deferral to a Roth. As you can see, Bob's marginal tax rate goes from 22% to 24% by doing Roth deferrals, resulting in an additional $7,000 of federal tax. What's your tax rate likely to be when you commence distributions? This is much harder to project because it requires making assumptions about both future tax rates and the growth of your retirement assets. We use planning software to help with this, but the farther out in time we go, the less reliable our projections are likely to be. In this case, we have 13 years before Bob expects to commence retirement distributions, and we project his marginal tax rate at that time to be 22%. A major caveat is that the tax bracket themselves could change. We currently have 7 income tax brackets, ranging from 10% to 37%. In Bob's case, we recommended a division between both Roth and traditional deferrals. We were able to fill up the 22% tax bracket with this strategy. We also like having a Roth account in retirement because it provides valuable year-to-year tax flexibility. Remember, the growth inside a Roth is tax-free, as are the distributions. Taking a target amount of Roth distributions each year in retirement helps meet the necessary cash flow while still keeping tax liabilities at a minimum. This planning varies from year to year and is one of the ways that we add ongoing value in working with clients. Timing of your retirement and when you plan to commence Social Security. When you plan to retire and when you plan to commence Social Security are also important considerations in the Roth versus traditional decision. Our software models each of these variables and allows us to compare and contrast traditional versus Roth deferrals. Possible inheritance of IRAs. A final variable to consider is the potential inheritance of an IRA. New rules regarding beneficiary IRA distributions can have a significant tax impact. For example, earlier this year we had a client aged 58 who inherited a $700,000 IRA from his mother. Under current rules, he will have to commence IRA RMDs next year and continue those to liquidate the account within 10 years. We formulated a plan to take the smallest RMD possible for the next 4 years while he's still working, and then take the remaining distributions equally over the next 6 years, allowing him to commence Social Security and maximize it at age 70. A good rule of thumb is if you're in a low tax bracket today, but expect to be in a higher tax bracket when you take distributions, then the Roth deferral is probably your best option. Conversely, if you're in a high tax bracket today and expect to be in a lower tax bracket when you commence retirement distributions, it probably makes sense for your deferrals to be pre-tax. However, as we've noted, each person's situation is unique. It's important to get professional advice when you're embarking on this decision. If you'd like to learn how we help our clients make smart decisions about money, we invite you to give us a call.